Good afternoon, everyone. Welcome to Market Insights, July 10th, 2024. I'm Matt Gordillo, partner, financial advisor with Park Edge Advisors, and I am joined by Rich Lowry, partner and chief investment officer, and Gavin Gowecki, portfolio manager.
Good afternoon.
Before we begin, let's get a quick word from our sponsors, please. All right. Thanks very much, Gavin and Rich. Summer is moving right along here, and heat's turned up, and some things are happening this week in the markets, and I thought we'd bring our clients and guests up to speed here. So, Gavin, maybe, as always, you could start us off with a recap from our last session.
Sure. Hey, Matt. Really, we're starting July in a bit of a phase transition, which is a new development, where we were really more in a quad one or Goldilocks or reflation at times up until this point environment. What we're seeing now as our signal is actually kind of flattened out. And we think we're in a phase transition, which has a low conviction score because a lot of our signals are neutral more than signaling a certain type of regime. So that tells us that it's appropriate to kind of stay the course, but phase transitions can be a good time to reduce risk a little bit, to kind of rebalance and see what's to come. And if you think about the events on the horizon for the rest of the year, that kind of makes sense. So for now, that's the update to start July.
Yeah, the only thing I would add to that, maybe just to explain kind of how we determine the dominant regime. In the market insights piece that goes out monthly, we refer to the risk matrix and the market regime. And to arrive at that, we're looking across all of global macro, a handful of major stock markets in the world, a handful of measures of volatility, the major foreign currencies, the major commodities, global bond yields, credit spreads, et cetera. There are 42 signals on there. The idea is that everything outside of the stock market has a closer connection to what's happening in the real economy than the stock market does. Stocks are driven by flows that originate as payroll deductions into a 401k plan, into a target date fund, where no one in the chain of command asks the question, should we invest the same way this month as we did last month? Because currencies, commodities, interest rates, credit spreads, inflation swaps have a higher sensitivity to inflections in growth and inflation. We can begin to see when these changes take place by observing what's going on in these other markets, and to the extent that it leads to a change in behavior that is a new market regime. We'll know from there whether it's a continuation of risk on or whether it's a evolution into risk off. Most markets, as Gavin said, are neutral, so they can't confirm quad 1, 2, 3, or 4. Think of an election where you have 4 candidates, quad 1, 2, 3, and 4, and of say 100 potential voters, only 10 of them show up to vote. So the leading regime could be the leading regime, but with a very low number of votes. That's quite different than if all 100 people show up to vote and there's a clear regime leader. So right now, they're equal percentages. The probability of quad 1, 2, 3, or 4 being realized at this point are all about the same. It's a very flat distribution, but the conviction is very low. And the conviction is low because of all these neutral signals. And to the extent that these other markets are making up their mind, they're looking at the uncertainty on the horizon. And to the extent that they start behaving in a manner that coalesces around a certain regime, then we'll be in a position where we can make adjustments to fit that regime.
Well, thanks for that analogy, Rich. We may need that later this year in the real election, but tomorrow, one of the key data points that we track from a rate of change standpoint that helps us guide us with our strategies is inflation. And an important report comes out tomorrow. So maybe you could share with us what you're looking for in that report.
Yeah, I'll go first on that, Gavin, and then if you have anything to add. We don't necessarily have a view for the specific headline number that comes out tomorrow. We do track probably a dozen different ways of determining inflation. And it's not really, what a single number is. It's more what's kind of the totality of the picture. And for us, it really boils down to, when is inflation going to get back to the Fed's target? We've been saying for over a year now that last mile of inflation is going to be the hardest. And because of that, higher for longer has been a term that we've used now for well over a year. And regardless of the headline number tomorrow, as we look across a number of inflation measures, we see a pretty consistent picture, which is inflation is stabilizing around 3%, which is well above the Fed's 2% target. And the drivers of the past disinflation look like they're dissipating. So NFIB, the National Federation of Independent Business, looks at pricing plans where they're looking at next 3 months versus actual pricing plans or actual pricing plans relative to the last 3 months. That's kind of stabilized, and small businesses are not done trying to raise prices, and it looks like that is stabilized, and that's well above the Fed's target. The Central Bank Research Association, they have an inflation measure that stabilized around 3%, which is well above the Fed's target. The Fed Consumer Expectation Surveys, same story, stabilize around 3%, which is well above the Fed's target. University of Michigan, same thing. 5-year break-even inflation rates, same thing. So you have all these different ways of looking at or measuring inflation that have some value as a leading indicator of what headline inflation is going to be, and they're all kind of saying the same thing. That inflation is kind of stuck. It's at a level that's well above the Fed's target. And I think the importance from that, and meanwhile, the disinflation that we've seen is kind of dissipating. A lot of it has come from the goods sector as opposed to the service sector. And it looks like goods disinflation or goods pricing has stabilized. A lot of the disinflation has come from oil prices coming down, and oil prices are up. Base effects, which is simply on a year-over-year basis, what is the inflation rate last year, and what are the next sequential inflation reports going to have to compare against to determine whether there's acceleration or deceleration of inflation. The base effects indicate that inflation could remain, more hawkish. So the importance of it is what happens if the Fed can't get inflation back to 2%. And our view is they probably won't be able to do it in the absence of a recession. It'll take a recession to actually get prices to come down such that inflation is at 2%. We may have to live with an environment where the unofficial inflation number is 3%. They tell us officially, no, inflation is still, our 2% is still our target. But in terms of what they actually do versus what they say, we could have to deal with a Fed that operates as if 3% is the unofficial target. And in August, they have their Jackson Hole conference. And Jackson Hole is where they float trial balloons on new theories. That's where they, rolled out quantitative easing before quantitative easing was a thing. They floated it at Jackson Hole, and that was the basis for it to kind of get legs and, take off on its own. We think it's very likely that at Jackson Hole, they float the idea of the so-called neutral rate being higher. The neutral rate is an unobservable number, something that you only see in a textbook. It's not a market price, but the Fed feeds it into all their models. They could come out and say, well, our models have determined that the neutral rate is really 3%. And that could set us up for a period of time where we have to live with inflation that runs above the Fed's target without the Fed, doing anything about it.
Thanks, Rich. Gavin, we've talked before, and you guys have stated that sometimes a little inflation can be good for equities. What would be the implications if the Fed does adopt this new policy, even if it's a neutral rate, so to speak, where it's not so published, but where they are accepting this inflation above 3%? What do you think the implications are for, quality factor, spreads with bonds, equities, really any asset class? What would be the implication there?
I think simply put, it would be, barring anything else that could happen. If we're just talking about that one variable, I think it would be more of the same. It would be quality outperforming, which we've been writing about that for over a year. Small caps continuing to struggle, but in pockets, maybe, there's some light at the end of the tunnel. In other parts, there may be more pain to come if that was the case, So I think, thinking about the scenario that Rich just laid out as a possibility, not that that is the one we're thinking is definitely going to happen, but if Powell did come out in Jackson Hole and kind of float that more hawkish, we're going to raise the long run rate. I think watching equities and then watching, now we've noticed that the consensus for a first rate cut has moved back to the September meeting as the greatest likelihood to see a first cut. So I think watching how the market has started to come around to that idea and what is said at Jackson Hole would be kind of the timeline to watch, and then notice, what happens to equities, through that type of, maybe there's like a correction or something like that brewing into the fall. So,
yeah, and I would add to that 3% inflation. When companies report revenue, they do it in nominal terms. They don't do it in real terms. So 3% inflation is going to mean 3% top line growth for businesses. And with 3% top line growth, for most companies, that is going to be helpful to delivering earnings, assuming they could pass the price increases on. The quality factor does well in that environment because they don't have debt, or a lot of it, and they're sitting on a lot of cash where they're earning, what are much higher yields now. Companies that have to refinance debt, companies that, have a maturity in 2025, 2026, those are going to be the ones that continue to struggle. If they do come out with a higher neutral rate, it's basically the Fed saying we're accepting the fact that we can't do much about inflation without causing too much harm to the economy. And I think the variable there is that term premiums on bonds could expand. Term premiums right now are kind of around zero. And think of that as a catch-all to compensate long-term bond investors for the risk associated with tying their money up. And that's something that could change as fast as people change their mind. They could say, well, the Fed's throwing in the towel on inflation. You're going to have to pay me a heck of a lot more to own long-term bonds than, currently. So it could have the biggest negative impact on bonds. And then, most investors, if they didn't know it, learned it in 2022, that the stock and bond correlation breaks down when you have inflation around 3% or above. So that 60-40 portfolio, that's an anchor for most portfolios, is built on the notion that when stocks go down, bonds hold up, and vice versa. That relationship, that correlation breaks down at 3% inflation or higher. So, to me, it would be a case that if the Fed does adopt a higher neutral rate, the 60-40 portfolio may need to be reconsidered or reexamined. And, kind of a buy and hold bond portfolio, the same thing. It would be a case that would argue in favor of actively managing risk in a bond portfolio the way you would actively manage it in a stock portfolio.
Well, thank you very much for the education this month, Rich and Gavin. I'll tell you, you've certainly been spot on with your inflation, monitoring and positioning, and certainly with the quality factors, the equity strategy has certainly benefited from that, and look forward to more continued success in those areas, and continue to do good work on the active management side and what's needed to be done on the bond and the fixed income side. So until next month, thanks again for your input, and we'll talk to you soon.
All right, take care, guys.